Good afternoon. So glad you could join us. This is our Navigating the Home Buying Process webinar, and we'll have an emphasis today on the process of obtaining a home loan. And today's webinar features 3 local loan officers. We have Jeff Boxler from Guaranteed Rate in Santa Barbara, Kathy Gray with Guild Mortgage in Oxnard, and Phoebe Jacobs with Caliber Home Loans in Santa Maria. I'm Corby Gage. I'm the Executive Director of Coastal Housing Partnership, and with us today also is Kim Pascage from the partnership. She's our program manager. You see her contact information right on the screen. So Phoebe, Kathy, and Jeff are all part of Coastal Housing Partnership's network of partners. And as part of that network, these lenders reduce their closing costs for their clients who are employees of Coastal Housing Partnership. So the format for today's webinar, I'm going to be asking Kathy, Jeff, and Phoebe some questions about the process of obtaining a home loan and just how to get ready to purchase a home. The remainder of our time together will be for you to get your questions answered. So we encourage you to put those questions in the Q&A, and those will be monitored by Kim, and she will get those out to us at the end. So we're going to be recording today's webinar, so we can send you the link to the recording afterwards. And so the webinar format, it's not like a Zoom meeting. This is a webinar, so it means we can't see you and we can't hear you. So if you have questions, do put them in the Q&A, and you can ask your questions anonymously if you like. There is a button or a section where you can say anonymous. So that's up to you how you ask your questions, but feel free to put those questions in anytime you think of those. Those aren't going to disrupt anything. We'd love to get your questions. We really want to tailor this webinar to you and to your needs. And since the first step in the home buying process is to meet with the lender to find out how much of a loan you can afford, the information you get today is going to really have you be better prepared to become a homeowner. We think this is such an important first step. So before we get started, we'd like to take an anonymous poll to determine where today's attendees are in terms of the process of buying a home. This way, we can gear our comments and responses best to meet your needs. So if you wouldn't mind completing that poll, and again, that's going to be anonymous, then we will be able to guide our responses better. Okay. Kim, does it look like everyone's kind of answered, or?
Maybe just a few more seconds if everyone could just complete the poll questions.
And on mine, you have to kind of use your gray bar to scroll down a little bit for the third question. Looks like everybody has figured that out because there's responses in there.
We can end that. Yeah. Okay, go ahead.
Okay. All right. Well, great. Thank you. So let's get started. Phoebe, would you please share a little bit about yourself?
Hi, my name is Phoebe Jacobs, and I am with Caliber Home Loans. I've been with this company almost 8 years now. And I've been in the lending business for 17 years now. So I am all about education. I like my clients to know what they're doing at the end of this process because it is a little bit overwhelming. And I'm located in Orchid, California.
Thank you. Jeff, would you tell us a little bit about yourself?
Yeah, so Phoebe and I must have, gotten on board at the same time. So 2004. Coming up on 18 years in July, and just love helping people from start to finish on the housing. I am based out of Santa Barbara. I'm the branch manager at Guaranteed Rate for Santa Barbara, and carry out my own loans. So that's what I'm doing and where you can find me.
Thanks, Jeff. Kathy.
Hi, I'm Kathy Gray. I am with Guild Mortgage in Oxnard, California. I handle loans, not just in Ventura County, but throughout California as well. I speak Spanish, and I have been at Guild for 12 years, but I have been in this business for probably 25, 30. And done all sorts of departments, processing, underwriting, escrow through the years.
Great, thank you. So you can see you've got a great team today to share information with you. So Jeff, let's start with you. What can a potential home buyer do to best prepare to obtain a home loan? And when's the right time for that potential home buyer to meet with a lender?
Yeah, great question, Corby. And this comes up a lot because I think a lot of people, when they have that first idea to buy a home, they're just not really sure where to start, who they can trust, how much of an obligation, if they reach out to people, they have to those individuals. My first kind of counsel for people is do two things. First of all, try to track down a lender, which you have any one of us three that would be more than happy to help you. Second is to look up what are the open houses in your area this weekend or the next couple of weekends, and go check them out to see what your just price point looks to be based on your lifestyle. So some people are wanting to live in a condo by the beach. Some people like just a condo in general. Some people want a big house up in the hills. Some people want a small house. But just to get an idea of what price points likely to fit your personal lifestyle needs is a great help to then come back to us as the lenders and say, this is what I'm seeing, feeling looks to be my price point of interest. And then we can kind of track off of that to determine if that's even realistic for you. If it's not realistic, we can reverse engineer that path into being able to figure out what is it going to take to get there, and potentially set you up on a savings plan. So it might be 3 months out, 6 months out, a year out, 2 years out, but at least we can work backwards and forwards. You'll come to find in meeting with us, it really is a dance, and it doesn't cost any money to meet with us by phone, web, in person, depending on what everyone's comfortable with. But that's what I find is usually most helpful, is to, even if you don't have an agent, all the local MLSs have a list of what the open houses are for the weekend. You see the signs naturally around your area, but just to pop your head in and see if that home price at $500,000, $1 million, $1.5 million is going to serve your needs. So we can really help kind of work through the numbers with you. The only other thing to add to that is a lot of people do wait too long before they reach out to us. And I've had so many friends over the years that were making good money, didn't think that buying a house was ever in the cards for them because of how expensive our part of the world is. So they didn't save and they spent a lot of money on other things. And what I came to find is those that believe that they were going to buy a house someday and were just chipping away at it, even if it's $50, $100 a month. And as they got pay increases, they put a little bit more money aside. They came to 30 years old when they partnered up and were having a kid, and now they've got some money set aside, and perhaps mom and dad can help with a little bit of the savings. Long story short, we don't need to go into all the details, but the big high level thing for you to understand is most everyone at some point wants to buy a home, and it might not always be generated because you are aspiring to buy a home, but more because your landlord needs you to move out because they want to sell the house. And this is the third landlord that's kicking you out on a, inopportune time for you. So eventually people really want that security and be empowered with their own kind of destiny by owning their home. So take it seriously sooner than later, and we can help reverse engineer that path for you.
So Jeff, it sounds like you're saying that even if you're not ready to buy for a couple of years, it's still a good idea to get with a lender and take that meeting.
Absolutely, because you'll find there's a lot of nuance to the experience, and Kathy and Phoebe are going to pick apart some of those details too. And knowing about it now rather than having to kind of figure it out online and not really sure whether it applies to you in this part of the world, because every part of the country is quite different. Phoebe said all over California. I have a number of licenses across the country that I can help in. And if you're buying in Texas or Florida, it can be quite different than California, and what you need and what you can trust from what it says online. So talking to someone local is really going to help you kind of clear the air and get to the answers that are helpful to your planning. So
Great, thanks, Jeff. Kathy, so sounds like once someone gets to a lender, they're going to ask for a pre-approval. Could you share a little bit more information about what a pre-approval is, why it's important, and what's involved in that process?
Sure. Okay, so it's important to know that there is a difference between a pre-qual and a pre-approval. Sometimes, you know, people will be playing online and they have calculators and, you know, this is what you could afford and, you know, this is what you might qualify for. That in essence is like a pre-qual. That means no one has actually reviewed your documents. Pre-approval, on the other hand, has more strength because an actual loan officer, not somebody off the web, but an actual loan officer has reviewed your income, your assets, meaning the down payment and the closing cost money. And they have reviewed your W-2s, your pay stubs, your tax returns, whatever the program calls for. And we have actually entered all that information into the automated approval process. Each agency, which means for conventional FHA, VA, and USDA, those are the common programs. They have a site where we input all your information, and it will give us a printout of your findings, whether it's approved eligible, and that's what we want. We want to see approved eligible. If we get an approved ineligible, we need to find out why. And once we have that approved eligible, that is a pretty good, solid upfront pre-approval letter that we can give you, and you can go in confidence and shop for the home that you need. And right now, a lot of open houses, or when you talk to the agent, that's the first thing they'll ask you, have you been pre-approved? Because sellers right now are not letting anyone in without a pre-approval letter.
Okay, so you're saying that you can't even get into an open house without a pre-approval letter?
It may be. I mean, you may find some that will, but you know, things changed at the beginning of COVID.
Okay, so that's really important. Now, Kathy, is there any cost to someone to get a pre-approval?
No one should charge you for a pre-approval. There are some lenders that may charge you to bring a credit, but other than that, you know, no one should ever have to pay for a pre-approval. That information is available to anyone.
Well, it sounds really important to get that done then. Thank you so much, Kathy. So Phoebe, we're going to throw a big topic at you, credit scores. Obviously, everyone's concerned about what their credit score is, what that means. And there's kind of a lot of misinformation out there. And I know that a lot of people try to do things to fix their credit that maybe they shouldn't be doing. So could you just share some information about credit scores and why they're so important to a lender, and just, you know, how they're determined and how someone can maybe improve their score?
Absolutely. So your credit scores are going to basically determine the program you're in, the rate you get. It's a big major factor in your whole entire loan process. So if your FICO score is on the lower side and your down payment is on the lower side, you're probably going to look more into the FHA loan. Whereas if your FICO scores are 700 or 720 and up, you're going to probably be looking more at the conventional loans. So you definitely want to have a predetermined, like check your credit online. There's so many companies out there that can look at your credit for you and just get a basis of what you think your credit is and an acknowledgement. Do you have any collections? Do you have any late payments? Is there anything that you can fix, you know, at the time or before you start looking for a mortgage? As far as how it's determined, you can have one late payment. That late payment can drop your scores by 100 points. A medical collection, if you have a medical bill that you haven't paid because you think your insurance company is going to cover it, or, you know, for whatever reason it slipped through the cracks, you can usually go to the collection companies and they'll delete those for you if you pay those. So you want to work with a lender that's going to help you with that if you do have medical, or if you do have credit issues, because a good lender will walk you through those steps on what to do to get your FICOs up. There are different ways. You can do a rapid rescore. There's just a lot of different things that we can do to help you get the best possible rate. But I would recommend monitoring that, and you can monitor it through your local bank, or, you know, like I said, any of the free credit reporting agencies that you see online. Ways to improve your score is you really want to, credit is based on the ability to manage your credit. So the more you use your credit and you pay off your credit, the higher your FICO scores are going to be. So the more credit you have doesn't necessarily mean you're going to have better credit scores. You don't want to have a Target card, a Kohl's card, an Amazon card. You know, the more credit cards that you have opened can actually drop your scores. You want to maintain a small number of credit cards and use those and pay those off on a consistent basis. Don't ever have late payments. Try to pay everything on time. If you can pay them off, you're going to see your scores go up. So you'll see your scores change basically every day. So when the credit reporting agencies say you charge $1,000 on your credit card, you're going to see your FICO scores drop because you've used more credit. Once you go back and pay that $1,000 off, you're going to see your FICO scores go back up. So, you know, you want to have your FICO the best possible number that it can be when you go to get a mortgage.
Phoebe, can I ask you one thing to expand on?
Yes.
Do you find that those bank credit scores are close to what you get when you pull? So could you speak to that? Because I see that being a common misconception for clients.
Yes, you do have to be very careful when you do look at those online credit companies. They have no risk factor. So when you go to Credit Karma or any of the other online companies, there's no risk factor involved. So the FICO scores can be basically manipulated at a higher FICO score. So you'll go on there and think, oh, I'm a 720 FICO. Well, then I'm going to pull your FICO and it's going to be a 680 FICO, because by getting a mortgage is a higher risk factor. But monitoring it on your own at your bank, you'll at least be able to see if you have any issues with anything. So you want to look for collections and late payments and things of that matter. But you do want to you want a lender to pull your credit, because you want to have an accurate number to begin with your lender.
Okay, so it sounds like a mortgage loan credit score is different from a consumer credit score, and that's what you're really focused on. So that sounds like, again, another reason to go see a lender and find out what you are dealing with in terms of your credit score. It also sounds like you're saying it's probably not a good idea to try to fix your credit on your own, but to do that in conjunction with a lender to ask them what they might recommend.
Yeah, you want to have a lender that's going to basically walk you through that. They should be able to talk to you about your credit scores, tell you what you can do to help you fix that credit score, and either let it go up organically in the next, 30 to 60 days, or if for some reason you're in contract and you want it to go up sooner, we do have the ability to do what's called a rapid rescore to try and get your FICO scores up in order to get you the best rate or best program possible for you.
Okay, great. Thanks, Phoebe. That's a big topic and so important. Thanks for enlightening us on that. So Kathy, we hear a lot about first-time home buyers and first-time home buyer programs. So who is a first-time home buyer, and are there indeed first-time home buyer programs available that people should be looking out for?
Oh, yes, absolutely. So anyone that hasn't owned a home in the last 3 years or has interest in a property in the last 3 years is considered a first-time home buyer. So let's say you owned one 10 years ago. Now you're a first-time home buyer again. And as far as programs, yes, there's programs with the city, there's programs with agencies such as CalHFA, Fannie Mae and Freddie Mac, which are our conventional loans. They also have their own separate program from the regular program. They're called Home Ready, and lost the tip of my tongue is the Freddie Mac, Home Advantage. And also FHA, a lot of people consider that FHA is a first-time home buyer. It can be, but it's not necessarily just a first-time home buyer program. VA obviously, is a great program for veterans to start with, 0 down payment if they choose to, as well as USDA is a good program for first-time home buyers. Each program will have its own guidelines. Each program will have their own rates. Each program will have their own fees. So while sometimes you think that you need a first-time home buyers program, but you have your own down payment, the benefit of the first-time home buyer may not necessarily be the best option. But it takes a loan officer to navigate through each program and decide with you which program is best for you.
Okay, so a potential home buyer doesn't need to find out anything about these first-time home buyer programs. They can just find that out from the lender. They would just ask the lender what's
Yes.
available, what would I be eligible for?
Yes, an eligible loan officer will cover all those areas.
Okay.
But
Alright.
it's good to ask questions, because if you end up talking to a loan officer that's not offering this information, then it's up to the consumer to ask all these questions.
Okay, you raised a good point about asking questions, and that any potential home buyer, anyone looking for a loan should feel very comfortable asking any question. There is no
Absolutely.
question that's too, basic, or, the lender's not going to go, oh, they don't know what they're talking about. The lender
No.
wants to make sure that you're on the same page with them. So
Yes.
ask all your questions and feel very comfortable doing that. If you get kind of pushback from someone or get an attitude, find a new lender. I mean, a good lender is going to really want to be responsive to your questions. So please feel free to ask them.
Absolutely. In this business, one size does not fit all. Everybody's different. And the more questions you ask, even if you have to ask more than once, once, twice, 10 times, a good loan officer will take the time to explain this. Keep in mind, you don't do this for a living. We do. So ask. Absolutely.
Good. Thanks, Kathy.
Mhm.
Okay, Jeff, we're going to ask you about down payments. That's always the big question. Everyone seems to kind of think that's a hurdle or an obstacle to home ownership. And do you need a 20% down payment? What are the options for down payments? What should someone expect?
Yeah, great question, Corby. The highest level is everyone probably coming on this call has heard 20% down is required. The reality is it's not required. And like Kathy said, there's so many different options out there nowadays to help clients get into housing. For example, there's 3% down, there's 0% down if you're a veteran. There's 10% down up to $2 million that we have. So it's a wide variety of different options to help people. FHA loans have a 3.5% down, 5% down for conforming for condo purchases. There's grant programs that can help you with some of that down payment for conforming loans. In Santa Barbara, you don't see much, if any of that. South Santa Barbara County, where I tend to do a lot of my loans, but outside the area, you do get a lot more of that, where there's great programs to help people scrape together that down payment. Don't forget that family what I always like to do is here's a few scenarios to help people based on what they're talking to me about and what their needs are. But I always ask them if parents have ever noted that they would like to help them with their first home purchase, to share those numbers with the parents, because parents tend to be elated to see that their child is actually being proactive and showing that they're responsible adults now, even if they're 30 years old, and tend to come forward with a little bit more money than they might have even had in mind if they're seeing that they might be able to help their children out. So never leave that off the table in conversation. Obviously, it's a sensitive topic in some families. But yeah, VA loans 0% down, FHA 3.5% down, grant programs, gifts. You can look at a loan from your retirement account of the 401k. Whether that's right or wrong, obviously, is to be debated and talked through with a financial advisor. But it's just nice to know at a high level that there's many different ways to puzzle the purchase together. Even looking at the seller as a potential creditor to be able to give you some money back for closing costs. If that's your struggle, you've got the down payment, but you can't afford the closing costs, asking the seller for some closing cost help is a potential too. So, and that's a conversation to have with your realtor and how to structure your offer in a way that they might be able to help you and partner up and still get the dollars that they're looking for in their pocket. So did I miss anything on that front?
No,
Yeah,
it's
go ahead,
oh, yeah,
Kathy.
Kathy.
What I miss?
Yeah, no, and you didn't miss it. Yeah, I just would like to add,
Yeah.
I've had clients in Santa Barbara. There are some employers like Cottage Hospital, or they use, I don't know if they still do. They will have down payment assistant loans for their employees. So don't rule out your employer. If they have such a service, not everybody will. Also, if you're buying a home from your parents, it could be a gift of equity. So that means no money is needed from you. It gets taken off through escrow and deducted. So there's no money from their pocket either.
That's a great point. Yep.
Yes. And also sometimes when you mention sellers, every now and then you'll find a seller that will carry back paper. So there's always options. So again, talk to your loan officer.
Good.
Yeah, and what carryback paper means really is they're the lender to you rather than us, the mortgage bankers. So the seller might give you, or you couple first mortgage with us with a seller, what they call carryback second, where the seller is providing you a second mortgage so you don't have to put as much down. And that might be more advantageous than getting a second mortgage from us. Or just doing one big loan from us that covers 95% of the purchase price or 90%.
So Jeff, it sounds like you should not wait until you've saved what you think is an appropriate down payment to go see a lender. You should see the lender and then see what is available and then determine what your down payment is from there.
Yeah, exactly. And it goes back to my comments earlier about the dance. Is like, you're always balancing with a home purchase of like, having the house now and a payment that fits you and how much money is left over in your bank account and when's the time right in your life. And so yeah, there's multiple loan options to be able to help you. If getting in the house now is more important, knowing that your pay is going to increase over time and you're like, I'm going to stretch it for the next year, but I'm knowing I'm going to get a big bonus at the end of the year, or I'm going to go from assistant manager to manager, and I'm going to get a $15,000 pay bump, or right. So there might be reasons that you cut corners, if you will, on the traditional recommended down payments because of what are the near and long-term benefits to you and or your family if you're looking after them. So that's a great no, Corby.
Great. Thank you, Jeff.
Yeah.
Okay, Phoebe. So sounds like we're telling everyone go see a lender. this is the time to go check in with the lender. Well, how do you select a lender? What do you look for? How do you choose a loan officer? And, do you shop by interest rates, or are there other factors? How do you even start this process?
You definitely don't want to shop by interest rate. So most of the good, decent lenders, we're all in the same ballpark. So we're all going to have relatively the same type of interest rates. You really want to pick your lender by, I'm pretty passionate about this. Like, you want to go with your gut. You want a lender that's going to hold your hand, answer your questions, and that they have your pocketbook in their best interest. So just because I come and say, oh, you can qualify for a $3,500 payment every month, you're going to look at me and go, are you crazy? I have childcare. And, so there's things outside of your credit report that you have to pay for, and you have to be comfortable with that payment. And just because a lender tells you you can afford a $3,500 payment doesn't mean that really fits into your budget. And you want to make sure that the lender, really holds your hand, answers your questions, doesn't just sweet talk you on the first one or two conversations and then gets you into their pipeline and then they don't really take care of you after that, which I find that happens quite often as well. You want to just be very comfortable and go with your gut. I wouldn't shop a ton of lenders. I would find 2 local lenders that you have been referred to, talk to both of them and figure out which one is going to work best for you. Who do you click with? Who do you feel like cares about you more often? Just because you have $50,000 in the bank, you don't have to put all of that money down on a house. You need to, my goal for my clients is to keep as much money in your pocket as possible. Just because you have it doesn't mean you need to use it. But with that being said, is that just your house saving and you want to put it down? So I'm a big gut person. Like, go with your gut, make sure your lender is working with you and has your best interest.
That's interesting. You raised the point about chemistry. So it's really a connection. Do you feel good with that lender? Do you trust that lender? That's your partner through this whole deal. So obviously you want to feel like this is someone you trust and there has integrity. What happens if you start with a lender and you think it's going to be a good fit, and then you kind of feel like it's not really a good fit? What's your obligation?
Change fast.
It's okay to change?
Absolutely. At this point in time, you've already been working with another lender. So if that's the case, you already have all your documents in hand, ready to go. So then go to the other lender that you were talking with and say, hey, can you get my loan done in 14 days? Like, I'm not happy with where I'm at. And, it cannot be about rate. Things, it has to be more about how you're being taken care of. So if you need to change, see if you can make that happen. You're not stuck with that lender. Appraisals can be moved sometimes. You can have loans be put on a rush if needed. It's not ideal to move in the middle of a transaction, so I wouldn't wait till the last minute to try and do that. But once, the first couple of weeks, if you feel like you're not getting the best service and you feel like your lenders dropped the ball on what they're doing and they really don't care, then get a second opinion.
Mm-hmm. And I'm thinking specifically too about kind of that during that pre-approval process, kind of when you're just finding out, getting that game plan going.
You want to know, like, how much education are they giving you? Are they teaching you about title and escrow, and are they answering your questions, and are you comfortable with the answers you're getting? Are you understanding what they're trying to tell you? Are they just talking mortgage lingo that's over your head and you have no idea what they're saying because we talk Chinese?
Right. Well, and that's a good point, mortgage lingo. So if there's something that you don't understand, don't sit there and think, okay, well, I'm going to go look that up when I get home. Ask right then, because it's very easy for a lender just to get into, a very comfortable language that they speak, which is not what most of us speak. So just ask, just say, well, what does that mean? What is that? How does that apply to me? So that's important to get through that lingo. Good point.
Yeah.
Okay.
There's never a dumb question. I think as a borrower, you have to understand that there's never a dumb question to ask your lender. So even if you think it's the dumbest question ever, ask them and ask them over and over again until you understand the answer to that question.
Good point. Good point. Okay, well, thank you. That's such great information. And I see we have a number of questions. And Kim, why don't we go to some of our attendees' questions and see if we can get those answered?
Yes, we have a lot of questions on deck here. So something that has been asked multiple times is when lenders are pulling their credit score, isn't that going to lower their credit score?
That's a good question. Phoebe, since you were on the credit section, I'm going to throw that one over to you.
Well, it won't lower their credit score, but they do have to realize that when we do pull credit, it will show a lower number than what they're looking at online. I would not recommend they have their credit pulled by multiple lenders. I think you can have it pulled 3 times in like 30 days. No, is that a different answer, Jeff?
Yeah, my understanding, I think they just extended it out to 45 days. I've always told people 30 days or less, but I think it's actually 45. If the polls look like they're coming from mortgage lenders, the 3 credit bureaus look at it as you're shopping for one mortgage. Where your credit gets dinged is when they look at it as if you're shopping for multiple types of debt at once. Then it looks like you're becoming a very risky borrower to all of us looking to lend you money. But yeah, I don't think it matters the number of times at all. I've never read anything online through the bureaus to say that. It's just a matter of if it's in a period of time, that 30 to 45 day window, then you're okay.
Okay, well,
And
that's
you
good.
should be getting the same credit score across all of them. Go ahead, Kathy.
You can basically have your credit pulled with one lender, have them give you your FICO scores so you know exactly what you're talking about. And then when you're shopping lenders, you can go to that lender and go, my FICO is a 679, what can you offer me? And they should be able to, a decent lender will talk to you about that and say, at that rate, this is, or that FICO score, this is what I can do for you, without really making you go through that process again. And then once you decide to choose a lender, then you definitely have to have your credit pulled again.
Yes, I was
Kathy,
just gonna
do you have
suggest
something to
that.
add?
Yeah, I was just gonna add, if you talk to one lender and they run your credit, maybe find out your scores and kind of base it on that. A loan officer shouldn't have to pull your credit to give you education. The other thing is also, sometimes different lenders use different bureaus and different bureaus use different modules. So your scores will vary along with your credit usage every day. So if, let's say, Phoebe pulls it on Monday and I don't pull it till Friday, we're probably going to have a different score. So, and then those Credit Karma deals and online, whatever, those are just for those are what you call consumer scores. Those are a guide. They're not exact. There won't be mortgage scores. So, it varies. So, but again, don't risk it and have every lender you call run your credit. And the best way you can do that is just don't give them your social security number. They can't score without it.
Can I push back on that a little bit?
Sure.
Here's a couple of reasons why is, especially in the jumbo world, if you're getting a jumbo loan, if you just tell me you have a 720 credit score because you ran it with some other lender 2 months ago, there's many of like our best interest rates right now from our jumbo lender. You have to have 3 trade lines that are open, active for the last 24 months. I cannot know that and how that shows up on your credit report by you just telling me a credit score. So you could very likely be getting misguided information from me if I'm just quoting you a rate based on what you tell me on credit score. Equally so, if you have a 722 credit score with Kathy, and like she's saying, it comes in at 719 with me, and I'm running at 721 credit score, you're going to get an inaccurate quote from me. So just know that you're playing a little bit with fire about you're not getting the most accurate information from the lender if you're giving them part of the information. So
that's such an interesting point that you bring up. It sounds like it's another good reason not to just rely on these mortgage loan calculators online, because there's so many variables that you're mentioning, Jeff, that go into what they would get approved for, what's available. So really sitting down and talking with the lender and having them understand your whole picture is really important.
Yeah,
getting
I
valid
think,
quote.
yeah, like Phoebe mentioned, like figure out a couple lenders that you really trust and run them with those two people.
Mhm.
Don't run them, you don't need to run it with 10 different lenders, but a couple is really important. And making sure that you are very well grounded in that pre-approval letter that you're going to eventually need, or even and if you know you're 6 months or a year out, absolutely just run it with one of them. But if you're trying to get a pre-approval going and wanting to make an offer in the next month or two, I think running it with the two lenders that you really want to use is important, and it's not going to lead you astray or harm you. But what could harm you is trying to hold too many cards close to yourself and not giving any of us enough information that Phoebe can give really good counsel to you, because she's kind of half blind about what's really going on. Doesn't see that there's a 30-day mortgage late that might be affecting things. And I can quote you at 660 credit score, but you have a 60-day mortgage late. And I might not even be able to do that loan for you that I'm quoting you. So just something to, add some color to it, of why having one or two lenders that you really trust, and give them your trust, and allow them to take good care of you by running that credit and looking under the hood. So
I think it's also important to recognize that, you talk about this 30-day window, is this is something you want to do kind of in a focused period. You wouldn't say, okay, well, November, I'm going to go see a lender, and then going to get through the holidays, and I'm going to pick this up again in January, go see another lender, because then you start having a lot of impact to your credit score, because this is a number of impacts then, rather than just that one that would count if you're doing it in a 30-day window. So kind of be focused about it, instead of, I'll do this now, and then a couple months later, I'm going to pick it up again. That's going to have more of a negative impact on your credit score.
And given time frame wise, Phoebe and Kathy, could you confirm this? We are 120 days most of the time your credit report is good for. So if you had it run today, for instance, you're good until what would be middle April so you kind of need to get into contract middle of March on a purchase, and that credit report is good for. So any comments, ladies, on that?
I can only think of one. Once we run credit report, we don't need to rerun it again. Let's say you start out with us 30 days later, you're going to escrow. We're not going to run that credit report again. However, at funding, keep in mind, an underwriter could pull your credit report again, just to make sure there's no new debt. That probably won't hurt your score. It's probably more of a soft pull. But just through the process, just be careful. Inquiries are crucial. They need to be explained throughout the process.
Okay, great. Thank you.
Don't go buy a new car when you're in escrow on a house.
No.
The first rule, right? Kim, what else is there? Questions?
Yeah, there's a lot of questions. Lauren, I think we got your question answered. You were asking, that you've been saving for the 20%, but it keeps going higher and higher. And can you enter with 10% for an $800,000 home? I think you had mentioned there's some options for that down payment. Yes, answered. Okay, great. And then another question was, at what point in the conversation with the lender should I provide all the confidential info to pull a pre-approval?
Kathy, you want to take that?
Sure, upfront and as soon as possible. Because you don't want, like I said at the beginning, you don't want a prequel, you want a pre-approval. And a pre-approval is based on reviewing the information. So if let's say you're not buying a home for another 6 months, then, maybe just talking to a loan officer, getting familiar with the process, maybe even, running your credit to see where you stand. That's a good start. But if you're ready to shop, we need all your documents. upfront so that you have a true pre-approval letter for you to be confident in writing offers. Also, the way we calculate income is so different than prior to COVID in some cases. If you're a W-2 person that just has pay stub W-2, 40 hours a week, 80 hours per pay period, easy. That's a no-brainer. But if you are involved in bonus income, commission income, if you're self-employed, there are so many ways that an underwriter is going to look at the income, especially with the COVID overlays, that the sooner you get your documents to us, the better we can actually tell you where you stand.
Great,
Can I
thank
add
you.
to Kathy's comment on that? Kathy, in you all, I'm not sure if everyone's aware of this, but the new contracts, the purchase contracts of 2022 now actually requires you, the buyer, and your agent to check whether you've been pre-qualified or no qualification, pre-approved or pre-approved by an underwriter. So if you've been, so that's definitely helping people move to the front of the pack. If you're competing against 7-10 offers, it being pre-approved by Kathy, Phoebe, or I is great, but that's second rate to being pre-approved by an underwriter. And being pre-approved by an underwriter does require all your documentation pushed into the underwriting, your credit score run, etc. So that's the gold standard now going forward. And most companies I'm finding are allowing that, which they 50-50 maybe last year. And I think more and more are starting to offer that to you, the buyer. So know that that's an option, and you can really be firm in your knowledge about what you can qualify for by having an underwriter look at your file. So.
Great, good info. Thank you. Kim.
Yeah, there's a lot of questions. Let's see. Tatiana, I think we answered most of your questions in the panel, but she's asking how much are you eligible for? Is there the debt to income ratio or income in general considered? Is credit score the main factor in how much you're eligible for? I feel like you guys touched on that, but is there anything else you want to say to that?
I can add a little bit. Yes, all the loan products, well, maybe with the exception of VA, because VA is a little different. They qualify you by residual income. But as far as conventional FHA and USDA programs, there are ratios that we have to meet, and they depending on the loan program, they're different. Some of them have a max of 41% of your income for the front ratio. And what I mean by the front ratio is your proposed monthly payment, which includes your principal and interest, taxes, insurance, and an HOA. The back ratio determines your back ratio debt. And that's what I'm talking about. The max conventional will have either 41, 43, 45, or even 49.9. Okay. FHA is a little bit longer. I've seen FHAs getting approved up to 56 back-end ratio. It's also going to take account all the other factors in the file. Okay, so the findings is going to analyze those ratios very carefully.
So Kathy, when you're talking about ratios, it's the housing expense divided by your gross income is your housing expense ratio.
Right, that's a front ratio. And the back ratio would be your proposed housing plus all your remaining debt that's going to stay behind. That would give you the back ratio.
Okay, great. Thank you.
Mm-hmm.
That's helpful.
And then, yeah, that's great. And then someone's asking, what's the difference between a mortgage company and a home loan from a bank or credit union? And what are the advantages and disadvantages?
Jeff, you want to take that one?
Yeah, happy to. So how banks look at you is they have one set of guidelines for their conforming traditionally and for their jumbo. And that's just one set of guidelines. Whereas I think all of us on the call are what's called correspondent lenders. A lot of people look at us as brokers. We're kind of in the middle, frankly, but what it means is we have multiple different investors or banks that buy loans from us. So if you don't fit the guidelines for one, we can look at the guidelines for the next. So some of us have our own proprietary products as well. So we're kind of why we all work, I think, for each of the companies we do is it allows us to offer multiple layers of support to our clients. If you don't fit one bucket, we can find another bucket for you. And worst case, we can even broker it outside of the doors of our company. So you tend to get more variety without having to make multiple phone calls if you go to one of our type companies, so Caliber, Guild, and Guaranteed Rate. Credit unions tend to act, as far as I understand, like banks, where they have their set of guidelines and what they'll do for you. So I would clump them together with a bank, though they tend to be a little bit less rigid than most banks can be. And then other than that, I tend to find that Guild, Caliber, Guaranteed Rate tends to work quicker in regards to being able to push your file quickly through the process, which can be a competitive advantage if you're making an offer competing against some banks that might require their borrowers to only get into a contract that's a 45-day escrow. And a lot of us can do, I mean, as short or less than 21 days. Everyone's hair is on fire when you go shorter than that, but we can do it. I mean, we have people doing 10-day closes, as crazy as that sounds, but that's conforming loans, appraisal waiver, because it's a conforming loan, and all the assets and everything are there already. So, but yes, timeframes tend to be where the three of our companies win out, on top of having a lot of different options for you, not just one guideline. And so if things go south, we can quickly resolve it. Whereas at a bank, when I used to work for Bank of America, it's a no. Like there's no other where I can go make a bunch of calls and see if you can find a solution. So
Thanks, Jeff. Kim?
Yeah, thank you. Yeah, that's great. Someone is saying I live in Goleta, but I'm interested in buying in Ventura, Oxnard. Should I be working with the lender that lives close to where I want to buy or close to where I live?
Phoebe, what's your take on who you should work with in terms of geographical areas?
I don't think that makes much of a difference where you're located or where your lender is located. I think, again, it's all about your confidence level in that lender. Because I mean, honestly, I rarely sit down with my clients. Everything we do is over the phone, and we're all very highly technical with what we do. And so, no, I don't think that matters at all.
Yeah, any of the lenders that work with Coastal Housing Partnership will loan in any of the three counties that we work in, which is Ventura County, Santa Barbara County, or San Luis Obispo County. So find the one you like and work with that individual. Kim?
Great, thank you. And then it says, if I'm unable to put 20% down, how do I get rid of having to pay mortgage insurance? Do you refinance in a year or two, or whenever the value of the home increases to have covered 20% of the initial mortgage?
Kathy?
Sure. Okay, well, first of all, that's a wonderful conversation to have up front, because there are programs to help you. If you only have 10%, we could do a HELOC with it. Some programs actually might even have a fixed second to help you. You could also do lender paid MI. You can pay the MI up front in the case of conventional loans only. So there's those options. But let's say you didn't. Let's say you have already a loan with 10% down and you have a mortgage insurance per month. Because mortgage insurance, even if you paid up front, it's non-refundable most of the time. So if you're already in a mortgage with mortgage insurance, if refinancing makes sense, that's very important to keep in mind, because if the rates are higher and it offsets the mortgage insurance, it may or may not make sense. If you have the value, you know, you're paying escrow and title fees most of the time all over again. So, and it'll take you a few years to recoup those costs. So a loan officer would ask you questions like, how long are you going to be in this property? You know, because if you say, well, you know, I'm only going to be here a year and I'm going to sell it. Well, then it may not make sense for you to refinance just at that time. You know, it's so every situation is going to be different. Talk to a loan officer that can help you determine, you know, which way is best.
Phoebe, so is refinancing the only way out of mortgage insurance, or if someone's in mortgage insurance, obviously refinancing can be an option. Are there other options?
There are other options. If you currently have an FHA loan, then you have to refinance in order to get out of that mortgage insurance. That cannot be dropped. But if you have a conventional loan, I have found that if you've had the mortgage for 2 years and you can get an appraisal stating that the house, whatever that new value is, your servicer should drop that mortgage insurance. But the 2 years is the key. So I've tried to do it before 2 years and I've not had any luck. The investors come back and they want the 2-year history of the mortgage insurance. So
But if you have mortgage insurance, you should keep an eye on it and see when it is that you can drop that.
yep, after 2 years, go to your servicer, ask them if they can, you know, if they can start the process on removing the mortgage insurance, and then you'll have to pay for an appraisal up front. And it's probably a good 60-day process, but it will be worth it if you can get that removed.
So you have to have at least 20% equity by that time, as well as the 2 years.
Correct.
All
And
right.
one more thing on mortgage insurance, that's kind of a good question, is when you go online and you're trying to shop for rates, when you put in less than 20% down, a lot of times they're going to give you a mortgage insurance that's based on FHA, which is like 0.85%, which is a lot higher. If you have good credit, this goes back to credit. If you have very high FICO scores, your mortgage insurance can be very low. So that is one thing you do have to pay attention to with your credit scores, is if you're putting 5 or 10% down, your mortgage insurance could be like $90 a month, not $300 a month. So a lot of times when my clients look at putting their difference in down payment, the difference between 5 and 10% is so minute when it comes to mortgage insurance that they will choose to put 5% down versus 10% down if they have decent credit.
Good point.
Good point. Good point. Because your FICO score is important. Your FICO score will determine not just the rate in the loan program, but also the amount of mortgage insurance you will pay.
And just a follow-up question, are you always charged mortgage insurance if you do not have 20% down?
No.
Jeff?
Yeah, so the high level, like what Kathy was talking about, is there's multiple ways around having mortgage insurance. One is getting a second mortgage. So mortgage insurance is in place to cover the lender. So you pay the insurance for the lender if you default. So essentially, the lender wants insurance on any loan over 80% most of the time. The way you get around that is either getting a first mortgage of 80% of the home value and then getting a second mortgage above that, or oftentimes the lender paid mortgage insurance. So they bake what I like to say, they bake it into the rate. So if you're going to get 3.5%, you might get 3.875% or 3.625 or 3.75%. And you never see a line item on your bill for mortgage insurance. You just know that you're getting a slightly higher interest rate because you're a higher risk to the bank. So that's even for jumbo products. So there are lender paid jumbo products that go quite high that you're not paying mortgage insurance, or what you perceive to be. You're paying it in another way in a higher interest rate. So,
And if you have a second mortgage rather than a full 90% first, to say you have an 80-10-10, you can avoid the mortgage insurance that way.
you got it, exactly. So that might be a better way to go because you get a lower rate on the first mortgage. You have a plan to pay off that second mortgage, or overall it's a cheaper payment than if you had mortgage insurance and a higher interest rate, or
Okay.
one of the above.
Great, thank you.
Great, thank you. And then I think I know that we know the answer to this, but it says that someone's not ready to buy for 1 to 2 years, but it's still a good idea to meet with the lender now. And I think it's a resounding yes, right?
I think we-
I think
Yeah, we're all
that's-
gonna nod heads. Now,
I think
now
that's
is
a
the-
theme of our webinar.
Now is the
Uh,
time. Go find a lender. Check out our list of coastal housing partnership lenders and meet with a lender. This is definitely the time.
And then this is more of a specific situation. Someone's husband is stopped working and is taking care of their son and doesn't have credit. And she has a fair amount of credit and some student debt. Where do they even start? And I mean, I think seeing a lender to kind of talk through each person's particular situation.
Yeah.
Yeah,
One thing that people don't realize is they don't have to put their spouse on the application. So if he's not earning any income, or I can't assume it's male, female, I don't know what the question, but you don't need them on the application. So they can gift you funds if they have the funds to help with the down payment, and it just go off of your credit and your income might be the way to go. But like Kim said, and everyone, talk to a lender. One of us would be able to more than quickly diagnose that and get you on a good path, so you're clear on what you need to do and what's possible.
Yeah, I think that's
Just-
right. Anything that's unusual like that, I would definitely go talk to a lender and find out, instead of, guessing or thinking, I have to wait until this situation changes. Find out that for sure from a lender instead of self-eliminating.
Yes, because once you talk to one of us, then you'll know. And let's say you on your own qualify for 300,000, but once the spouse gets, back to work, if they even need to, they may push them up to a higher price point.
Mhm.
I want to jump
And
in really quick.
Yes,
Yeah.
Phoebe.
When you have situations like that, when you have that much student debt and that much going on in your situation, if one lender tells you no, I would almost advise to go to one other lender and get a second opinion, because you're not really sure that first lender, I don't want to be offensive, but they may not have really known what they were doing, and another lender may have another program that you might fit into better, and they can kind of, structure your loan to make it doable for you. So just don't take your first no. If someone shoots you down for whatever reason, go to a second lender and get another opinion.
That's a really good point, Phoebe. I think that that in that case where someone tells you flat out no, or whether someone qualifies you and you think, wow, I think I could have qualified for more. Why are they, pre-approving me at such a low number? Get a second opinion. And
Yeah.
there's no cost to do that. And I think that's a wise thing to do.
Yeah.
And not only
And
that,
yeah, go ahead.
I was going to add, if conventional isn't for you, it is a great backup for some people. So, and remember, it's the first loan you get, just like the first house you find, it may not be your true dream house. So it's just a stepping stone into the if you have to start FHA and you can later on move into a conventional, that's great. If you have to start with a condo instead of a house, that's great. It just depends.
Yeah, lender will let you know what your entry point is, right? So,
Mhm.
Right. Kim, are there other questions?
and most loans they're asking are jumbo in California, is that right? Or not necessarily?
Yeah, with the recent conforming increase, you ladies could speak to your areas, but I mean, Santa Barbara is now 760. What's Ventura, 800 something?
I think we're the same as Santa Barbara for
You didn't go up anymore this time.
548, I thought was conforming.
No, you're 6 something for baseline, but we have high balance conforming now 700 some in Santa Barbara at 760.
Yeah, I have it written down
And
somewhere.
in Los Angeles, just for example, I know none of you are buying there, but they're up to over 900,000 for conforming. So it's
That's
definitely
true.
it's brought more purchases. So in North County, Santa Barbara, definitely San Luis and Ventura into conforming territory. most pretty much every home in Santa Barbara is not going to be conforming yet.
Phoebe, what is it for North County?
What do you find, Phoebe?
You're muted.
You're muted.
Sorry, what were 760? We all work in so many different counties.
Yes,
We work in, like, all of us, like, those numbers don't really flow off the top of our head. I was very happy you guys.
right. I'm trying to look for my notes because there
We're
is.
all over California,
increase.
so it's like, okay, what county are we in now?
Yes.
So Phoebe, you definitely could do conforming loans and easily get into some homes in North
Oh,
County.
yeah, definitely.
Okay,
Yeah, because
great.
it's in the mid to high sevens.
Mhm.
Yeah, so
Over
it's not jumbos for every home now. So
No.
that's good news.
No.
Kim, are there other questions?
Oh, sorry, Kathy, did you have?
No, I
No,
was just
I think-
gonna say, even though some programs will fit the jumbo arena a little better, but that's another story. That's
Mhm.
And I know this will be our last question because I know we're over time. Someone's saying that they have good credit, they have and how much of an income do you need on a $600,000 home purchase with 20% down? How much in general, how much of an income do you need?
I
Phoebe,
could
do you
give
wanna
you
take
a
that,
guess
or-
if you- It depends
have
on the
it.
loan type is the hard thing.
Yeah.
I'll give you a number though, just to satisfy the itch.
No pressure here.
It's fine. I have a quick little calculator I created for this stuff.
and keep in mind, it also depends on your debt.
Yes.
On a conventional loan, they're saying.
We're gonna assume you have no debt, okay? So if you have no debt and you're buying in the range that we're all in, or in the counties that we're in, your housing payment is probably gonna be 2750-ish. So 2750. Conforming loans, you're being able to go 50% debt ratio. Everyone agree with me? On a 20% down, you're not gonna go.
49.9, yeah.
So you're gonna need income of $66,000 a year. That's
Okay.
using 3.5% interest rate, which might be higher or low depending on the day right now and not paying points for paying points.
I'm impressed with these on the spot calculations. So
Yeah, that's a good ballpark.
Yeah, so budging up or butting up on 70K, you could buy that place.
Okay, great.
No debt. And a lot of caveats.
So I know there's so much more information we could get from these great loan officers, and I really appreciate your time, Jeff, Kathy, and Phoebe, but we are out of time. So if anyone does have any additional questions, please follow up with our office, or you can see you have Jeff's information, Kathy's information, and Phoebe's here too. So we will be sending you out the recording. And please do reach out if you have any questions going forward. Thanks for spending your lunch hour with us. All right. Bye-bye.
The pleasure. Thank you for the invite.
Pleasure. Thank you.
Bye-bye.
That was great. Thanks again, ladies.
thank you.
Thank you.